Welcome to Financial with How. Today we are going to build up our conversation on investments around government securities, popularly known as Treasury bills and Treasury bonds. Now, these are such key areas of engagement because they tend to be a very easy entry point for starting to make passive income that is fairly low to medium term risk. Why we say low to medium term risk is because governments have typically been considered to be safe or stable places to whom you can lend money and be able to be guaranteed of a return. Now, just a brief of what treasury bills and bonds are. So treasury bills are usually facilities that are government issues requiring finance placed out to the public, who then come back and make that investment in government with a guarantee of a certain income. This, however, are short term and run for a period of 3 months, 6 months to 1 year. Normally will not exceed that period. They actually list it in days: 90 days, 180 days, and 365 days. They also tend to carry a lower interest rate because they are running for a shorter period of time and are quickly repayable. The next option are bonds, and this is where the long-term government lending occurs, where again they determine money they need for different things and they issue bonds for different things. So this can be infrastructure bonds, development bonds, and things like that. And this can run anywhere from 5 years, 10 years, 20 years, 25 years, that the government keeps issuing these bonds and receiving money from the public, from which they then give a certain percentage of return. Now, I recently learned that the African continent is actually the most expensive place, or one of the most expensive places for governments to take loans. But also, this is a benefit to investors because it means it's also the place where investors make the highest return. In comparison with, for instance, the United States, where the average interest rate on government securities is about 2%. In the African continent, it goes as high as 13%. And this income usually comes 2 times a year. So it means you quietly sit, put in your 1 million, and you're receiving 13% 2 times a year. The potential here is great, only that being a stable source of income or a fairly secure one of the government, then you don't get a return beyond that as compared to some of the other investment options that may have higher risk and get you a higher return. Now, to be able to engage in the purchase of treasury bills and bonds, you have to get an account from the central depository of the central bank of the country, or Kenya of Kenya. To do that, you visit central bank. They have a desk that supports the opening of these accounts. They'll give you a form which they require to be signed by your bank to confirm your details and where money will be moved to and from. Then you can at any time visit the central bank website and see the bills and the bonds that are listed. Be part of those who make a bid to purchase. Normally, if you have a higher amount to give, then you're able to give to be part of those who determine the interest rate that is given, although it's usually within a capped amount. If not, then you're just a rate taker. Take the rate based on what has already been determined for the particular bill or bond. This is a new area that many people think just belongs to some elect few, but you can come into the bond market with as little as 50 to 100,000 Kenya shillings and continue to build up from there. I urge you to also do due diligence. Don't put all the investment in one basket, and especially if you have a good amount of finance to invest, look at a place like Securities where you can show off a little bit. It is a bit, no risk. And also add a key thing to think about as you look into government securities is how secure is that government? What are their policies and things like that? Because then that determines their ability to repay off their debt. This ideally is we as investors giving government money and getting a return on it. Thank you for listening. It's been great. This is how